The global banking system is a fortress built on confidence. It is a cathedral of ledger entries, digital promises, and assumed trust. We have been told that if you buy a contract for an asset, you effectively own that asset. But what happens when the map no longer matches the territory? What happens when the claim on wealth outnumbers the actual wealth by a factor of 400 to 1? We are not talking about a stock market correction. We are not talking about a recession. We are talking about a structural break in the mechanism of pricing itself. This story begins with a whisper in the trading rooms of London and New York, a whisper that has now turned into a scream. The global banking system just revealed a crack. And while the mainstream media is focused on interest rates and political theatre, this crack is spreading through the silver market faster than anyone realizes. Today, we are going to take you to a moment in the near future, Monday, February 9th, 2026. A day that historians might one day label as the Great Delivery Failure. Silver is trading in the low to mid-80s per ounce, but that price is a lie. The real story isn't the price, it's the panic. In this comprehensive breakdown, we are going to deconstruct the mechanics of the silver market. We aren't here to sell you hype. We aren't here to trade emotions. We are here to look at the cold, hard mathematics of a derivative bubble colliding with a physical reality. We will analyze why the institutions that have controlled this market for 50 years are facing an extinction-level event. We will expose the difference between paper silver and physical silver. And most importantly, we will answer the question that terrifies the central banks. What happens when the world demands delivery of an asset that simply isn't there? Buckle up. The definition of value is about to be rewritten. To understand the crisis unfolding in 2026, we have to first understand the architecture of the deception. The modern precious metals market is not a market of metal. It is a market of contracts. For the past 40 years, the price of silver has not been set by the physical exchange of bars between a miner and a manufacturer. It has been set on the futures markets, specifically the COMEX in New York and the LBMA in London. In these casinos, billions of ounces of silver are traded every day. But here is the catch. 99% of that silver does not exist. It is what we call paper silver. Let's strip this down to the basics. Imagine a car dealership. This dealership has one car on the lot, but the dealer sells a claim on that car to 100 different people. He tells them, "Don't worry, you don't need to take the car home today. I'll keep it here for you. Here is a piece of paper that says you own a car." As long as those 100 people don't all show up on the same day to claim their keys, the scheme works. The dealer collects fees, the buyers feel wealthy, and the system hums along. This is called a fractional reserve system. But today, looking at the data from our scenario in February 2026, the ratio of claims to actual metal has breached a critical threshold. The relationship between open interest, that is, the total number of betting slips, and registered inventory, the actual metal available for delivery, has hit 416%. Let that sink in. 416%. For every single ounce of silver sitting in a vault, legally available to be delivered, there are more than 4 people holding contracts who believe they can demand that ounce. This system was designed to facilitate hedging. It was supposed to help farmers and miners lock in prices. But over decades of greed and financial engineering, it mutated. It became a mechanism for price suppression. Banks realized that they could print infinite paper contracts to flood the market and drive prices down, even when physical demand was rising. But paper has a fatal flaw. You cannot use paper to build a solar panel. You cannot use a futures contract to manufacture an electric vehicle battery. You cannot use a digital ledger entry to guide a Tomahawk missile. Eventually, the real world comes knocking, and right now, the knocking is getting violent. Let's fast forward to our target date. It is February 2026. The price of silver has broken through the suppression ceiling. It is trading in the mid-80s. For years, analysts predicted that if silver ever hit $50, the banks would step in and smash it back down, just like they did in 2011 and just like they did in 1980. Trading desks built their entire risk models around this assumption. Their algorithms were programmed to fade the rally, to short sell into any strength, assuming mean reversion. But this time, the algorithms are broken. Mock interview, voice actor. You have to understand the panic inside the desk. We had models that said silver creates a double top at $50. We were shorting with leverage. But every time we sold paper, the physical buyers just absorbed it. They didn't care about the price. They needed the metal. We kept waiting for the pullback. It never came. We were getting margin called every hour. The liquidity, it just vanished. This is the difference between a speculative rally and a structural shortage. In a speculative rally, people buy because they want to sell higher later. In a structural shortage, people buy because they are terrified they will never be able to buy again. In this 2026 scenario, we are seeing the short squeeze of the century. But unlike the GameStop squeeze, which was about a failing video game retailer, this squeeze is about a strategic element essential for modern civilization. The institutions, the massive bullion banks like JP Morgan, HSBC and others, are facing a reality they never prepared for. They are short the market. They owe metal they do not possess. As the price gaps higher, moving $5 or $6 in a single day, their losses aren't just arithmetic, they are exponential. And the velocity of the move is what kills them. When a market moves slowly, you can hedge, you can maneuver. But when silver gaps up day after day, breaching resistance levels without hesitation, psychology shifts from skepticism to pure, unadulterated panic. The question shifts from, should I buy silver, to, can I even get silver? Now, let's look at the smoking gun. In the middle of this chaos, the Chicago Mercantile Exchange, the CME, has launched a new product, a 100-ounce silver futures contract. On the surface, the PR department tells us this is about democratization. They say they want to allow the little guy, the retail trader, to participate in the silver market. The standard contract is 5,000 ounces. At $80 an ounce, that's a $400,000 contract, too rich for most. But in financial markets, there are no coincidences. Why launch a micro contract exactly when physical availability is tightening? Why create a new exit door right when the building is on fire? We have to ask, who does this actually serve? This isn't about retail access. This is about liquidity fragmentation and settlement diversion. By creating a smaller contract, the exchange attracts a swarm of retail speculators who have no intention of taking delivery. These traders just want to gamble on the price. They are cash settled. This creates a pool of liquidity that allows the big players, the whales who are trapped in massive short positions, to unwind their trades against a flood of retail paper. It's a relief valve. It's damage control. Furthermore, look at the settlement terms. Does this 100-ounce contract guarantee you a specific bar of silver, or does it give you a pooled certificate? Does it give you a claim on a shared pile of metal that you can actually withdraw unless you accumulate 50 contracts? If you can't back a truck up to the warehouse and load it, you don't own silver. You own exposure to the price of silver. And in a crisis, those are two very different things. This move by the CME suggests they see the wall of demand coming. They know the 5,000-ounce institutional market is seizing up. They need to dilute the pressure. But as we will see, you cannot print your way out of a physical shortage. To verify the claims of a crisis, we must audit the vault. But reading a COMEX warehouse report is like reading a magician's diary. You have to know what the words actually mean. The COMEX reports two categories of silver: eligible and registered. Eligible silver is simply metal that meets the purity standards of the exchange and is sitting in a COMEX-approved vault. But here is the key. It is owned by someone else. It could belong to a wealthy individual, a hedge fund, or a jewelry manufacturer. It is storing there. It is not for sale. It is not available to settle a futures contract unless the owner decides to sell it. Registered silver, on the other hand, is the metal that has a for sale sign on it. This is the inventory available for immediate delivery to satisfy futures contracts. The media often conflates these two numbers to make the stockpiles look healthy. They say, look, there are millions of ounces in the vaults. But that is a deception. In our 2026 analysis, the registered category has been bled dry. It is being drawn down month after month. Why? Because smart money is taking delivery. They are moving metal from registered to eligible, taking it off the market. Or, even more significantly, they are removing it from the vault entirely, what we call out of the gate. When you look at the borrowing costs, the lease rates, they are spiking. In London, silver lease rates have jumped above 6%. In a healthy market, lease rates should be near zero. Why would you pay 6% interest to borrow a lump of metal? You only do that if you are desperate. You only do that if you need physical metal right now to fulfill a manufacturing contract or a delivery obligation, and you cannot find it anywhere else. A high lease rate is the market screaming, "There is no silver." Meanwhile, the paper price on the screen is trying to maintain a poker face, but the physical market is calling the bluff. While the Western financial centers play games with paper derivatives, the East is playing for keeps. We are witnessing the greatest wealth transfer of physical commodities in history, moving from west to east. This phenomenon is driven by a simple, unstoppable force: arbitrage. Look at the premiums. In our timeline, Asian markets like the Shanghai Gold Exchange are quoting silver at premiums approaching 650 over the New York spot price. This creates an economic gravity that no regulation can stop. If you are a global bullion dealer, the math is simple. You buy silver in London or New York, where it is artificially cheap due to paper shorting. You put it on a plane or a ship. You sell it in Shanghai. You pocket the spread. This arbitrage is acting like a giant vacuum cleaner, sucking physical inventory out of Western vaults, COMEX and LBMA, and depositing it permanently in the East. And I say permanently for a reason. This is not a two-way street. Due to China's capital controls and strategic reserve policies, once precious metals enter China, they rarely leave. The Chinese government encourages its citizens to buy silver and gold. They view it as strategic sovereignty. So, the flow is unidirectional. The West is selling its family heirloom furniture to pay the rent, and the East is buying it up at a discount. This drainage creates a structural deficit. We aren't just talking about a bad month. We are talking about 4 consecutive years where global silver consumption has outpaced global silver production. The estimates are staggering: a 200 million ounce annual shortfall. The world mines about 800 million ounces. It consumes over 1 billion ounces. Where does the difference come from? It comes from above ground stockpiles. But those stockpiles are finite. And when they run out, price is the only mechanism left to balance the equation. And that price will not be $80. It won't be $100. To understand the severity of this crisis, we must unlearn a common misconception. Wall Street treats gold and silver as siblings. They are often traded together in the same basket, but physically, they are strangers. Gold is a monetary metal. It is hoarded. Almost every ounce of gold ever mined in human history still exists today. It sits in central bank vaults. It hangs around necks as jewelry, or it is stacked in private safes. It gets melted down and recast, but it does not disappear. Silver is different. Silver is a strategic industrial metal. It is the most conductive element on the periodic table. It is the most reflective. It is thermally superior. Because of these unique chemical properties, modern civilization cannot function without it. But here is the terrifying reality. Silver is consumed. When silver is used in a Tomahawk missile, that silver is gone forever. When it is used in brazing alloys for plumbing, or in antimicrobial bandages in hospitals, or in the conductive paste of a circuit board, it is dispersed in such microscopic quantities that it is economically impossible to recover. We are taking a finite element from the Earth's crust and scattering it into landfills. We are literally throwing away our strategic future. This creates a one-way flow out of the available supply pool. While gold inventories grow every year with mining, available silver inventories are shrinking. We are burning the furniture to keep the house warm, and now the fire is demanding more fuel than ever before. For years, the silver market was boring. It was driven by photography and silverware. But those days are gone. We have entered the age of the industrial vortex. 3 distinct technological revolutions are converging simultaneously, and they all share one common appetite: silver. First, let's look at the green energy transition. Photovoltaic cells, solar panels, are the primary driver. As the world pushes for net zero carbon emissions, solar installation is exponential. But the technology is changing. We are moving from older solar cells to newer TOPCon and HJT cells. Why does this matter? Because these newer, more efficient panels require significantly more silver paste per unit. The industry is trying to thrift, to use less silver, but physics is stubborn. You cannot cheat conductivity. Efficiency requires silver. Second is electrification. An electric vehicle, EV, uses roughly 2 to 3 times as much silver as a traditional gas combustion engine. It's in the battery management systems, the thousands of electrical contacts, the navigation screens, and the charging stations. Every time a government passes a mandate banning gas cars, they are legally mandating a massive increase in silver consumption. But the third factor is the wild card that nobody saw coming 2 years ago: artificial intelligence. AI is not just code floating in the cloud. The cloud is a physical place. It is millions of servers in massive data centers. AI chips run hot. They require massive amounts of power and incredibly efficient thermal regulation. Silver is the best thermal conductor on Earth. As we build out the infrastructure for the AI revolution, the interconnects, the specialized components, the 5G towers to transmit the data, we are creating a new, voracious source of demand that didn't exist a decade ago. These industries, solar, EV, and AI, are not price sensitive. They are performance sensitive. And this leads us to the most dangerous economic concept for the short sellers: inelasticity. In a normal market, if the price of something doubles, people buy less of it. If the price of steak doubles, you buy chicken. But silver has a unique economic characteristic: inelastic demand. Let's imagine you are Elon Musk or the CEO of a major solar manufacturer. You are building a $50,000 electric vehicle or a high-tech solar array. The amount of silver in that car might be about 1 ounce. At $25 an ounce, the silver costs you $25. Now, imagine the price of silver explodes to $100 an ounce. Does the car manufacturer stop making cars? No. The cost of the silver has quadrupled, but it only added $75 to the cost of a $50,000 car. It is a rounding error. It is negligible relative to the final product price. However, the absence of silver is catastrophic. Without that tiny amount of silver, the $50,000 car does not run. It is a brick. This means that industrial buyers will pay any price to get the metal. They cannot substitute it easily without losing performance or reliability. When push comes to shove, Apple, Samsung, Tesla, and Lockheed Martin will bid the price of silver to the moon rather than shut down their assembly lines. They are not speculators. They are desperate buyers. And in our 2026 scenario, these are the whales stripping the physical market bare, bypassing the COMEX and going straight to the refiners, leaving the paper traders holding the bag. If demand is exploding, basic economics says supply should rise to meet it. If the price goes up, miners should dig more. Right? Wrong. This is the supply cliff. The dirty secret of silver mining is that it barely exists. Pure silver mines are incredibly rare. Approximately 70% to 75% of the world's silver comes as a byproduct of mining other metals, specifically copper, lead, and zinc. This is critical to understand. A copper miner does not care about the price of silver. He cares about the price of copper. If the global economy slows down and the price of copper drops, that mine might shut down or reduce production. If that happens, the supply of silver drops, even if the price of silver is skyrocketing. Silver supply is inelastic to silver price. It creates a paradox where a recession could actually cause a silver shortage by shutting down base metal mines. Furthermore, you cannot just flip a switch to open a new mine. It takes 7 to 12 years to go from discovery to pouring the first metal bar. It involves permits, environmental studies, political bribes, infrastructure building, and capital raising. And look at where the silver is. The world's largest producers are Mexico and Peru. These are regions currently facing immense political and social instability. We are seeing labor strikes, blockades by local communities, and governments talking about nationalizing resources. In Mexico, ore grades are collapsing. We have been mining silver there for 500 years. The easy stuff is gone. Miners are having to crush tons of rock just to get a few grams of silver. It is becoming more expensive and energy intensive to get the metal out of the ground. So we have a situation where demand is exponential, AI, solar, but supply is stagnant or declining. This is not a market that can be fixed by the Federal Reserve raising interest rates. This is a geological bottleneck. But wait, the skeptics say. What about recycling? If price goes high enough, won't we just melt down old spoons and electronics? Recycling cannot bridge this gap. As we discussed, silver in electronics is used in microscopic amounts. Recovering a tiny flake of silver from a discarded iPhone requires complex chemical processing. It is toxic, expensive, and energy intensive. Unless silver hits massive price levels, hundreds of dollars an ounce, urban mining is not economical enough to flood the market with supply. Furthermore, the easy recycling sources, Grandma's old sterling silver tea set, have largely been melted down in the previous price spikes of 1980 and 2011. That low-hanging fruit is gone. The buffer stocks are depleted. This brings us back to our crisis point. February 2026. The industrial users have realized the mines can't save them. The recyclers can't save them. The paper markets are lying to them. So, they are panic buying. We are approaching the March delivery cycle on the COMEX. This is the moment of truth. This is when contract holders have to decide, do I roll my position to the next month, or do I stand for delivery? In the past, banks could offer cash incentives to get people to not take the metal. Here is $1 million, just walk away. But how do you bribe a solar panel manufacturer who needs the silver to stay in business? You can't. They don't want fiat currency. They want the physical commodity. When the industrial base demands physical delivery at a rate that exceeds the registered inventory, the exchange has two choices. Default. Admit they don't have the metal and force settle contracts in cash, which destroys confidence in the system forever. Price reset. Allow the price to rise to a level where people actually want to sell their physical jewelry and silverware. And given the amount of currency printing in the last decade, that price is not $80. It is likely multiples higher. The system is now trapped. The crack the transcript mentioned is not just a trading anomaly. It is the sound of the dam breaking. In the final part of this documentary, we will look at the endgame. We will compare this to the Hunt brothers in 1980, analyze the systemic risk to the major banks, and discuss what you, the individual, should be doing right now before the window of opportunity slams shut. Because when the music stops, there are only so many chairs, and the music is slowing down. Whenever silver bulls get excited, the skeptics point to one event: 1980. The Hunt brothers. For those who don't know, Nelson and William Hunt were two Texas oil billionaires who tried to corner the silver market. They bought massive amounts of physical metal and futures contracts. They drove the price from $6 to nearly $50 in a matter of months. But then, the empire struck back. The exchanges, terrified of the losses facing the establishment banks, changed the rules overnight. They announced liquidation-only trading. You could sell, but you couldn't buy. They raised margin requirements to insane levels. The price collapsed, the Hunts were bankrupted, and the status quo was restored. Skeptics say, they will just do it again. If silver rallies, The powers that be will change the rules and crash the price. But they are missing the fundamental difference. In 1980, the buyers were speculators. They were two guys leveraging their fortune to make a profit. You can force a speculator to sell. You can bankrupt a hedge fund. But today, the buyers are not speculators. The buyers are strategic industries. You cannot margin call the strategic necessity of a nation. You cannot tell the Chinese solar industry to stop buying because the price is too high. You cannot tell the US military to stop building missiles because the COMEX is in trouble. In 1980, the demand was artificial. In 2026, the demand is structural. You can kill a speculator, but you cannot kill physics. The industrial machine needs the metal to function, and no amount of rule changing by the CME can conjure physical silver out of thin air. This is not a corner. This is a run on the bank. So why does the establishment fight this so hard? Why manipulate the price at all? Why not just let silver go to $200? Because of concentrated risk. The short positions in silver are not held by mum-and-pop investors. They are held by a handful of massive bullion banks, the too-big-to-fail institutions. Reports indicate that at times, just 4 to 8 banks hold the vast majority of the short contracts. If silver prices rise gradually, they can manage it. But if silver gaps up, if it pulls a nickel 2022 and doubles in a week, these banks face catastrophic losses. We are talking about tens of billions of dollars in margin calls. If a major bullion bank becomes insolvent because of a silver short squeeze, the contagion spreads. It triggers cross defaults in the gold market, the currency markets, and the interest rate swaps. This is why the regulators look the other way. This is why the tamp-down teams operate in the shadows. They are not just suppressing the price of a shiny metal. They are trying to prevent a systemic financial accident. But holding a beach ball underwater takes energy, and eventually the beach ball slips. When it breaches the surface, the violence of the pop will be proportional to the depth it was held down. So, how does this end? When the vaults are empty and the industrial giants are pounding on the door, what happens? The exchange will likely declare force majeure. This is the legal escape hatch. They will say, due to unforeseen market conditions, we cannot deliver physical silver. We are settling your contract in cash. Imagine you bought a contract promising you 5,000 ounces of silver. You wanted the metal, but the exchange sends you a check instead. They give you the fiat currency equivalent at a price they determine. Meanwhile, in the real world, on the streets of Shanghai, Mumbai, and Munich, the actual physical metal is trading for double or triple that paper price. This is the bifurcation. The moment the paper price and the physical price divorce completely, the paper market becomes a zombie, irrelevant. The physical market becomes the only reality. If you are holding paper silver when this happens, you don't own silver. You own a lawsuit. You own a claim against a bankrupt counterparty. We have covered the history, the mechanics, the supply cliff, and the banking crisis. Now the question is, what do you do? This analysis is not financial advice, but it is a survival guide for a collapsing paradigm. Rule number 1, if you can't touch it, you don't own it. In a crisis of confidence, counterparty risk is the only risk that matters. ETFs that are not fully allocated, unallocated pool accounts, and futures contracts are dangerous. If you want exposure to silver, the safest form is physical possession. Bars and coins in your own hand or in a private non-bank vault outside the financial system. Rule number 2, watch the premiums. Don't just watch the spot price on TV. Watch what it costs to actually buy a coin. If the spot price is $25, but dealers are charging $40, the spot price is a lie. That spread is the real inflation gauge. Rule number 3, understand the timeline. These things happen slowly, then all at once. The inventory drawdowns are happening now. The mine supply is failing now. The industrial demand is ramping now. Waiting for the perfect entry usually means missing the boat entirely. Silver is the only asset that is both an essential industrial commodity and a monetary metal. It is the bridge between the old world and the new. For 50 years, we have lived in a world of paper illusions. We believed that debt was wealth. We believed that printing money created prosperity. We believed that a digital promise was as good as a physical bar. That era is ending. Monday, February 9th, 2026, isn't just a date in our scenario. It represents the mathematical inevitability of what is coming. The physics of the market are reasserting themselves. The global banking system has revealed its crack. The silver market is the fault line. And when the earthquake happens, there will be two types of people: those who are holding paper promises and those who are holding the real thing. Which one will you be? If this breakdown helped you see through the fog, smash that like button so this information can defeat the algorithm. Subscribe to the channel to stay ahead of the collapse. And tell me in the comments below, do you think the government will let silver soar? Or will they change the rules again? Let's debate.